All right. I'm doing
Take it away.
All right.
This is always a production.
Welcome back to Value After Hours. I'm Bill Brewster here with my co-hosts, Jake Taylor and Toby Carlisle. Jake, what are you going to be talking about this week?
I'm coming to you from a snowy cabin in Lake Tahoe, so apologies if my audio is not great this week. But I'm going to be talking about arbitrage and why it might be a good time to start skating towards that puck.
And Toby?
I'll be talking about Constellation and the giant Mark Leonard and acquisition as a strategy.
And I'm going to be discussing the Terry Smith Fundsmith letter right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
We'll do it live.
We'll do it.
Let's go. Let's do it. Do you want me to do Constellation?
Yeah, go ahead.
So I've got this ongoing theme where I'm looking at companies that basically are set up to do acquisitions. So we looked at Barry Diller and IAC first, then looked at Heiko with the Mendelsons. So I'm kind of, and then if you're going to do that, naturally Berkshire Hathaway is sort of the original gangster. Maybe Singleton with Teledyne maybe that's the original. Buffett kind of perfected it. But Mark Leonard and Constellation is kind of, I think, for me, they're a little bit under the radar. I've known about them for a long time, never bothered to read the letters until this last week. So I read the letters and I was kind of DMing you guys as I was going through them. I'm leery, I'm highly skeptical when I see somebody using Buffett's language in a letter, because I see it in hedge fund letters all the time. And so when I first started reading it, I was like, well, everybody loves this because he writes like Buffett, but so what? And then I kept on reading, and I'm kind of in love with Mark Leonard at the moment. I'm having this like long distance love affair with him. Guys kind of figured out something incredible, like what Constellation does. So Constellation is they target these VMS, vertical market software, and they make really small acquisitions. The acquisitions are like typically $5 to $10 million. When I look back at some of the older articles that came out about him not that long ago, 5 years ago, they were looking at $2 to $4 million acquisitions. To put that in context, that company is a $30 billion company. And so the way that he's achieving these acquisitions is he has sort of distributed this acquisition. So it's not like Berkshire where Buffett's doing all the acquisitions. They've got distributed acquisitions. So they're getting each sort of downline does their own. It sounds like an MLM marketing kind of thing.
It does.
But
You got your upline and your downline, and then you sign people up.
when it gets complicated like that, like you immediately start getting nervous, but not in relation to Constellation, in relation to MLM. So the background on the guy, like there's not much information on, not many photographs of him on the internet. By all accounts, he's a giant. He's 6'5", played rugby, might have come from South Africa or England. Nobody really knows. Got an MBA, was a gravedigger at one stage. Worked in venture capital until 1995, took some funding, $25 million in funding from OMERS. I don't know what that is. I've never encountered that before. Do you guys know who that is?
No.
Mm-mm.
So he runs from 1995 until they list in 2006. And so he lists to give them an exit, I think, basically, because they didn't take any cash in the listing. They just, that allowed all of their outside investors, the venture funds, to exit. And so they basically take Buffett's principles, targeting high return on invested capital companies, and then they sort of incentivize them to return that capital back to the mothership, and they keep on deploying it. And that's a conscious strategy of theirs to target much, much smaller acquisitions, because as acquisitions get bigger, you pay a bigger and bigger premium. So they've kind of figured out how to not grow the size of the acquisition, but to grow the whole organization. They do lots and lots of acquisitions. They don't use debt. It's been a kind of monster run. I'm I'm kind of newish to it, so I'm not going to give you all of the great insights that you guys probably know more about it than I do, but I'm a fan.
Enjoy that honeymoon period.
So tell me, what am I missing?
No, I don't think you're missing anything. I think the only knock nowadays is that, like, can they keep doing what they've been doing at the same rate and an increasing rate to justify the increasing market cap?
So there's the Value Investors Club, there's a couple of write-ups about Constellation in there, and that's the question that gets asked every time. So they say, or the write-ups say, that there are something like 30,000 of these VMS businesses around that are of that sort of scale, $5 million type scale. And if they're prepared to expand into Europe, then it goes up by another 50%, something like that. Like there might be 48,000 or something like that between that $7 to $10 million, because maybe that's the level that they're at. So maybe they go up a little bit. But then the problem, I think their real problem, rather than just the running out of kind of runway to buy stuff, is just the fact that software as a service, everybody's figured out that's a good business. So that stuff is expensive now. So I think maybe you slow down the rate of acquisition, you only hit what you can, and you just wait for the market to come back a little bit. I don't know.
Big TAM.
Yeah.
So I went back to the Scuttleblur bullpen to do a little bit of background on this. Something that I think is really awesome. I'm with you, Toby, right? Where I start to see people quote Buffett and I start to get real nervous. But this is Mark Leonard talking about expensing his own stuff. He goes, I've been president of CSU for its first 20 years. I've waived all compensation because I don't want to work as hard in the future as I did in the last 20 years. Cutting my compensation will allow me to lead a more balanced life with a less oppressive sense of personal obligation. I'm paying my own expenses for a different reason. I've traditionally traveled on economy tickets and stayed at modest hotels because I wasn't happy freeloading on the CSU shareholders. And I wanted to set an example for the thousands of CSU employees who travel every month. I'm getting older and wealthier and find that I'm willing to trade more of my own cash for comfort, convenience, and speed. So I'm afraid you'll mostly see me in the front of the plane from here on out. I mean, he reminds me of those guys from Fastenal. Like the management team from Fastenal takes pride when they go to a town and they can stay at their in-laws' house. Like some of these guys are just, they're cut from the right cloth, I think. And I had told you I don't know that I really love the CSU letters as much as everybody else does. I think part of that is like I was prepared for Nirvana, and maybe I found out like I was just reading normal things. So a bit of I think maybe, high expectations hurt my perception, but he really does seem like the real deal, and his track record certainly supports it. It's interesting. I thought the same thing, can they continue to do it? I talked to Liberty on Twitter about it. He's pretty active in the name, and he doesn't think size is going to preclude good things from here going forward.
One of the interesting things that that Leonard introduced me to this is Leonard's term, high performance conglomerates, so HPCs, and then he lists out some HPCs that I will go into over the coming weeks. But that term I don't think really exists outside of Mark Leonard using it, but I think it's a good one. So I just sort of looked at there. If you search that term, there's not a great deal that comes up, but there are these guys who've done a little analysis of HPCs. And so what separates an HPC from just a typically acquisitive company is, I think it's a value discipline. But if they just do this sort of top-down analysis of it, the thing that they say separates good acquirers from bad acquirers is just doing lots of acquisitions. And
it's a learned skill.
Bill shared this with me this morning, this Bain Capital's done some research, and they find exactly the same thing. Like, I don't necessarily trust somebody who's doing a whole lot of acquisitions just because they're doing a whole lot of acquisitions. But I think it kind of makes sense if you think about, if you don't pay very much, your payback period is shorter. You should be able to do more acquisitions, like that you can recycle the capital faster to do faster and faster acquisitions. And then you get some skill in it. You're going to get better at it. If you set up to do acquisitions rather than thinking about them as a sort of strategic thing. You're thinking about them, how can we just maximize the rate of return? I think that it works.
Any concern about the if you have, like, think about Rome, in its heyday, and the further that you kind of get away from the central part of Rome, the more that it breaks down, and the bigger it gets, almost sows its own seeds of destruction. Well, the culture of Constellation, the further you get down, away from the mothership, away from Leonard, how could it be as tight, or how can it be as
it's not going to work
clean?
As well. I'm not necessarily advocating
well, right?
investing in the stock. I had a look at, like, the valuations on any of these companies are just make you bleed from the eyeballs. Like, they're just shocking, face-ripping valuations. And my hat is off to anybody who can get comfortable with those sort of levels of value. And it's been expensive for a long time. It's gone up a lot.
Yeah.
I'm definitely not advocating buying the stock. It's probably going to quadruple from here because I said that. But I think that, of course, I think that, they're all on like 50 times PEs, and they're probably getting closer to the mature end of their growth rather than, lots of runway. Yeah, I think that I like the distributed model. I think it's a much better way of managing than that sort of top-down type model. But I think Buffett has said this too. It just means that every now and again you're going to have an absolute catastrophic error that you could have otherwise avoided if head office had known about it. But on balance, it's a better way of doing it.
Yeah, I think the other thing that was interesting about Constellation was it appears as though their incentive structure is total revenue growth and return on invested capital. So there's a nice sort of you can send capital back, and maybe you can't make as much acquisitions and grow your revenue, or you could spend a ton and drive your revenue, but your return on invested capital would go down if you get stupid with it.
Smart.
So it's a nice tension of alignment of interests. And I wonder, it was the Bain Consulting thing that I sent you. I wonder if that's why they find that good consistent acquirers have better results. Maybe it's because they're thinking of incentive structures and how to integrate different cultures, and more than just being like a learned habit. It is a learned habit, but it's almost a way of life.
Or even
where
don't
you're just
integrate
obsessed
them.
with it.
That's one of the things that Leonard says that I really liked. He's like, I think, what is culture? How would you get all of these cultures? You can't. And he said some of them are going. So he says we just leave the cultures alone at the level of the acquired company, and some of them are going to die out because they're bad cultures, and some of them are going to be very good, and they're going to learn from each other, and they're going to get better and better as they go along. And I think that's a pretty good approach. That's a sort of robust to life kind of approach. That's the way living things kind of make advances. And I think that's if you want to keep the whole species moving, you can't. If you have one rule for the whole group of them and that rule is wrong, you're dead in the water. But if you've got lots of little variations that can, some of which will survive whatever comes next, then that's a good survival mechanism.
Yeah, and my understanding is that it seems like they've been doing more to try to cross-pollinate some of the, if someone has a good idea. I think there's been more, I don't know if management moves around like GE, but I remember reading about how they've trying to get more structure as far as the information cascading between the cultures of things that work.
It's interesting. I'm just trying to think in terms of the things that unite HICO, IAC, and Constellation so far. And the really interesting thing, the one thing that I think that stands out more than anything else, and this was the title of the Forbes article for Dilla and IAC, no moonshots. I think that's been the key to all of them. HICO, everybody, all of these guys are just doing smaller acquisitions, small bolt-on acquisitions all the time, rather than trying for some sort of monster game-changing acquisition. Not to say
didn't Diller pay $4 billion for Match though? I mean, that's not nothing.
But I think in the context of what that's true. That is true. But he initially put in $1 billion, something like that. I think that they've been quite. I think at the $4 billion level, it was quite mature. They owned half of it. They might have bought the other half for $4 billion.
Yeah.
or whatever they got to, up to 85%. Anyway,
I think it's interesting. I mean, Markel is one that's trying to do it, and the time that it seems to take to get the snowball rolling, and I think that they've learned, from what I understand, a fair amount from this Catco issue that they had last year, where they maybe got into a line of business that was slightly different than something they were comfortable with. And there are trade-offs to the acquisition strategy, and you're bound to have some problems. But one thing that I like about Markel a lot, and where I actually think Liz, that LA Hall Forever thread went a little wrong, was when she had mentioned that she didn't think that culture was a competitive advantage there. I think culture is a massively competitive advantage there, and it's really, really not. It's not tangible. I can't put it into numbers. People ask me like, well, how many acquisitions do you think they'll do in the future, and how would you underwrite that? I don't really know. What I'm certain of is those guys are going to work every day thinking about the right things, and that when there is, the chance to pounce, they're going to do it in what I perceive to be a smart way.
Is it a competitive advantage, though? Is it just table stakes? Here's what you have to do to succeed.
Well, I don't think that everybody has the same incentive structures, and I don't think
that's
that everybody.
Replicable, right?
I don't know, man. You gotta set your incentives up the same way, and I'm not sure how many people have the freedom to do that.
But I think, even Leonard says he's going to. A few years ago, he said, "I'm going to stop sharing so much detail because there are a lot of imitators out there."
Yeah, I mean that's fair. I think it can be replicated. I don't think it's easy to replicate, though. It's one of those things that
simple
in a text,
but not easy.
Yeah, textbook, it might be easy to draft, but the execution of it and actually living it and being patient enough to wait for the deal that makes sense and then to execute it when the chance is on the table, I just think it's a lot easier said than done. But I could be wrong. I mean, I don't know.
Do you guys ever want to be in that position of running a holding company like that?
I mean, that's the dream, isn't it? To be the Buffett style.
Permanent capital.
Yeah, that's what every dorky value guy out there is trying to get to.
I'd be good being a six-man on that.
That's the value
wet about dream. Running it. You call me Rick Fox of the that type of company. I'd be totally happy with it.
Who's Rick Fox?
Exactly.
Who's Mark Leonard?
Rick Fox used to play for the Lakers. He was married to Vanessa Williams.
Was he the sixth man?
He certainly wasn't a start. Well, maybe he was a starter for a year or two there, but it wasn't anything. He's not the guy anybody knows, which I'd be fine with. I don't need the glory.
And here you are with your face on a podcast, Bill.
Yeah, well,
exactly.
Getting dozens of downloads.
I was just about to quote Tupac and say, "All I want is money. Fuck the fame. I'm a simple man." And here I am on a podcast making no money, so I don't know what I'm doing.
But getting no fame either, so don't worry about it.
That's right. Yeah. Well, anyway.
Shall we kick on to the next topic? Jake, do you want to give us yours?
Yeah, I recently read Kate Welling and Mario Gabelli's book called Merger Masters, and it was basically profiles of a bunch of guys who have were doing merger arb and risk arb, into the 70s, 80s, 90s, even to today, and what I found really interesting was that, like, you don't hear about that much at all these days. Like, nobody's really talking much risk arb, at least in my circles. And a lot of that has to do with low interest rates. Apparently, like, that kind of kills that business because they only earn, a couple points above whatever the interest rate is typically. And the smart ones then they move in cycles, and they'll do risk arb during boom merger times, and then they'll move into like bankruptcy special situations after the bust. But what I found, I wonder if we shouldn't be asking ourselves if there might not be a renaissance of this on the horizon at some point, because it seems out of favor today. And, we've talked before about different flavors of value and, each of them sort of having their particular time to shine. This might be one that you want to do a little work on ahead of time to be ready for when that season comes again. So what do you guys think about that? Do you want to learn more about it to be ready?
We had the mailbag question on FCAU just last weekend, right? Fitbit looks like it's trading at a pretty decent discount. I haven't done the work. I think merger arb is a really interesting strategy. I've been fortunate enough to get to know Mario a little bit, so I got to listen to Kate talk about that book. One, I think the strategy is super interesting. Two, the stories in that book are super interesting. And somebody had asked her, who is the best or scariest person in that book? And without hesitating, she was like, by far, Paul Singer. Like, that guy does not lose, and the people walking through that office are not interested in losing, but it is a terrifying place to work, for the right reasons. But that was sort of interesting, an interesting tidbit. I think it makes sense. I've long thought merger arb is a good strategy. It's not one that I think I'm prepared to execute on my own.
I've done lots of merger arb. I like it as a strategy, but as you say, it's one of those things that there are just long periods of time where it's not a good strategy because the spread's not wide enough. The thing that is different now the thing that's different between now and the 80s is it was hard to track this stuff down in the 80s. You needed to know how to see the filings, find the stuff, understand what the deal was. Now there are like Google merger arb. There are websites that give you all of the dozen or 20 deals that are on right now with the spread, and they give you what the IRR is, like, it just calculated, and the sites are out there for free. So it's a lot less work than there used to be, and I think as a result the spreads have closed. You got to get smarter. Having said that, I've had some merger arbs that were like 100%, and I'm not talking about IRR. I'm talking about they were literally like 50% of the bid, and at 50% of the bid, I'm prepared to put in like a point or two just to see what happens, because you can get a good return and probably not lose much if the bid doesn't go through. So I like it as a strategy. I've done it in a previous life, and I watch it regularly.
Yeah,
but it's tight now.
I played Monsanto. That worked out pretty well. That turned out to be a fairly decent one. I would want to do it where I was somewhat comfortable with the underlying if something busted. Like the Sprint T-Mobile one doesn't really interest me because I really don't want anything to do with Sprint if it doesn't go through.
What if you're long short?
Yeah, you could do it that way. You
get both sides. You get a little hedge. That way, if it busts and they both fall apart. I did it with. I did it when all of the healthcare mergers were trying. All the Humana, long Humana, and that deal ultimately didn't go through. But it in a funny way, the deal took so long. Like it was initially, it got. There was a concern about the deals that were being done to move the head office overseas to get out of the tax jurisdiction, and the Obama admin put a stop to that. But that deal wasn't being done for that reason, but it blew open because all of the ARBs are in all the same positions, and they've got to conserve capital where they can. And then it got blown apart because there was a DOJ antitrust, but United was so much bigger, and there was another deal going on that at the time that if that deal went through, they'd been number 3 biggest, and if the deal didn't go through, they would have been second, maybe still behind United. It took the deal so long to go through that United sprinted ahead of the other 4 that were still in a deal, and so when the deal busted, the stock actually went up, and so because it was held back by the deal. So that's a sort of dream arbitrage, and I had a lot of that in my PA and in the fund.
You're right for the wrong reasons.
Yeah, that happens a lot.
Well, you put yourself in the right ponds and good things can happen even if it's for the wrong reason, right?
Get lucky. That's my strategy.
Yeah, well, that tweet that I sent out a year ago just caught fire again today where I said, the traditional value guys understand the left tail mitigating risk. Traditional growth understands that the right tail can be a lot longer than I think value gives it credit for. The marriage of the two concepts is nirvana, but it's not easy.
You can figure that out. Yeah, 100%. It's a good insight.
And I think like what you were just talking about is a good example of how traditional value, I think, sort of wins, in that there's some price that a lot of bad outcomes are priced in, and that's where you bet. And then a lot of things can go, there's a lot of paths that can happen that aren't worse than the price you paid, and you can win. So you don't necessarily have to be right on the reasons that you're buying. Where a lot of the names that I look at today, I think you have to be right on the path.
3 different things.
Yeah, and that, and if not 3, there's a lot of precision that these, I think, prices require. And I think a lot of people are saying, well, I'll just hold longer and it's a great business and, over the long term that's going to work. Yeah, we'll see. I mean, in 10 years, we'll have the conversation and maybe people will say, see, I told you. But it gives me an uneasy feeling.
Yeah, that's where I am. But that's what being deep value is. Just missing out on all the parties.
Yeah, well.
Cinderella sitting at home.
Yep.
Bill, what's your topic?
Well, it's an interesting segue there, given that I wanted to talk about the Fundsmith letter. And, I guess that it's interesting. I guess the conversation that is going on, or seems to be going on, is there are people that are saying, like, value's dead, PE multiples are useless, sort of, because it's crappy businesses that are trading at low multiples anyway. And
Same as it ever was.
Yeah, well, and I guess that, Terry Smith is incredible. I mean, I think if you look at his letters, if you look at how he approaches the world, I think it's really awesome. And as I've talked about now for 3 weeks, right, I'm trying to determine whether or not I want to morph more to that game in some way. Yeah, that's right.
Let's give the shout out to that. The best comment that we've seen on YouTube so far. Kevin Zatlukal, Zatlukal. Watching Bill slowly turn into a growth investor is definitely my favorite character arc on this show.
Thank you. I'm glad that me questioning everything that I've ever thought is a good character arc.
I laughed out loud in IRL. That was great. Thanks.
Yeah. But I think there's a lot of merit. A lot of the conversation, I think, gets lost in why certain things work and why certain strategies are right for the right people. And I mean, I've said before numerous times, I think low valuation can work. I think it's best in an ETF diversified wrapper. I think that systematically trying to take advantage of behavioral bias makes a ton of sense. For what I'm going through, and discretionarily, I really don't want to spend the time researching why GameStop can get out of their lease structure to then go on to the next deep value idea, to then go on to the next one. Like, I don't know that I'm going to call it Compound Town because I don't know what else to call it. But sort of those better GARPy businesses, I think you get more juice out of your time spent in research. It requires a lot of patience, but I think the knowledge base is a little bit more leverageable, given that I think ETFs are the way to play deep value strategies. So anyway, that's, I guess, why my character is arcing.
So let's tell us about the Fundsmith letters. What's the most recent Fundsmith letter?
Well, I mean, Terry Smith is a guy out of the UK that I would not know about, but for Twitter. And he basically says we buy good businesses, we pay reasonable prices, and then we do nothing. Now, he doesn't do nothing because he sold 3M, but his turnover is super, super low.
Has that been a mistake or not?
Not for him. He's destroying everything.
Selling 3M.
Oh, no, I don't think so. Actually, I just saw today that it's apparently getting crushed, but I don't follow it very much. That entity is sort of in my too hard pile. It's more of a macro bet than anything in my limited understanding. So anyway, I just, he owns things like Estee Lauder. He owns stuff like Philip Morris. His gross margins in his portfolio, I really like how he lays out his portfolio versus the indexes. Like his gross margins and his look-through gross margins are north of 60%. His return on capital employed, I'm pretty sure, is north of 20%, probably 30%, but I'm not looking at it right now. It's a really interesting way to approach the world. And I think one of the I bet he and Russo think very similarly. I haven't looked at all of his holdings, but they seem to be slower moving industries that, brands matter, distribution matters, and you can sort of buy and own for the long term. I'm sure somebody's going to correct me on that, but that's what it looks like to me.
Yeah, I had a look at that letter. I love the way he writes, and I like the layout of that letter too. He's much closer to that compounding style than he is to my style, but that's worked really well for a lot of years now. So, and I think that it's going to work in the future, whatever happens to deep value. I think it's a very robust approach.
Something interesting. When we were talking about Heiko, I said something silly, and it was sort of flippant when I said it. I said, well, you know what? It's a 2.8% free cash flow yield. It could go down to 5%. And then I'm like sitting around thinking, and I thought, well, that is a 50% haircut. So if you don't care about the difference between making 2.8% or 3%, buying today really doesn't matter if you're going to hold forever. But the thing that sucks when you're paying those prices is share buybacks don't get you much juice. Mm-hmm. And, a 50% drawdown when you're looking at a 2-3% free cash flow yield every year, that's a lot of return. You got to really believe.
That was
16 years, 17 years.
That was the feeling that I had looking at these, all the HPCs, the high performance compounders that Mark Leonard lists out. I was looking at them like the returns are ridiculous, and I understand the strategy really well. So I would definitely buy these companies at a price, but it's just so hard to get comfortable with them when something like Constellation, I think, was on. It's approaching a 50 PE, so you're getting a 2% yield. It's growing fast still, like it's still growing in the 30s, I think, which is monstrous growth. And then, you look at your yield and you add on the growth, and all of a sudden it's an interesting position. But the growth is such a big component of it that you have to be right on that. And that's where all of the other questions, like Jake's first question was my first question: how big is this universe of stuff that they can keep on buying? At what stage does the edge of the empire just get too big and start to crumble away? Don't know the answer to those. Got to be right though.
Well, I know I bring it up a lot, but look at 3G, right? I mean, they had done pretty well, and then they got to size where maybe both entities are suffering from this. I'd like to think that Bud isn't, but it could be suffering from a size problem. And now, the best brand in their entire portfolio has a virus attached to it, which isn't great.
Who knows? It might help.
Yeah, well, it's
I
hard
haven't seen
enough
so
to
much Corona
in China
advertising
right now. I'm not sure we need a coronavirus.
I have seen more Corona advertising than I've seen anything else for the last few weeks.
Jesus Lord, people, if you're outside of the U.S., buy some AB InBev products, please. Corona, I don't care what. And if you're in the U.S., buy Stella.
Continental wife beater, they call it in the UK.
Stella?
Stella.
Yeah. That's what people, it's interesting how brands do that. People have said like Stella is just trash over there in a similar way that Budweiser is here. But then Budweiser is supposedly liked globally, from what I understand.
Budweiser was a premium product when I was working in the there's a drive-through. You guys might not know what a drive-through is, but that's where in Australia someone can drive up and buy alcohol.
Nice.
That's a real thing. I used to work in one, had to run around. The Buds were premium products because they were imports and they were expensive, and so they were kept in like a special lock case so that people couldn't make off with them.
Wow, that's impressive.
It's interesting how brands can take on different meanings in different geographies. The Budweiser, the Asian IPO documents are pretty interesting to look through if anyone's somewhat interested. I wouldn't recommend it. Stay away. It's bad for your health. Leverage and volume declines.
Shall we move on to the questions?
Yeah, I wanted to give a quick follow-up. Not that people are listening to a finance podcast for this stuff, but I think it was 2 weeks ago, Jake, you asked what mattered. And, you know, the passing of Kobe, I was not a huge Kobe fan when he played, but it's made me like think about, you know, how fragile life is. And, you know, to the extent that people listen and are engaged with this podcast and we can add some value to their lives, that's stuff that matters to me. So anyone that's listening, thank you. Toby and Jake, thank you for giving me a shot. I was a nobody before this and less than a nobody now, or less of a nobody now. But, you know, it's been fun. So,
wow, this is a really sentimental moment right now.
I've been thinking about it a lot, man. I mean, you know, I don't know.
Yeah.
I think one of the reasons that I have thought about it a lot is like seeing how his peers respect him. That's all I really want out of this game. Like at the end of it, I just want people to be like, Brewster did it right. Now, you know, that may cost me some points in the business category, but that's like what I strive for. So
that's the only fame worth having. That's the only fame worth having.
I think so too, right?
You don't want to be known by anybody except for people in the industry who think that you did it the right way. 100% agree with you there.
Yeah, because that means you actually did shit right. Otherwise, you're like a marketing guy, and come on. I'm not. I mean, that doesn't impress me. Good for you. Like, make your money, whatever. But that's not what I'm after.
I'm right here, Bill.
Right.
Oh, you know what? We forgot to. We didn't do Jake's DC Buffett story. You got to tell that story.
That's not ready yet.
It's not ready.
Let's give him. No. Let's give him a couple weeks to see what happens, and then we'll tell the good version of it. How about that? Let's tease it.
That works.
Okay. You have to tune back in for Jake's DC Buffett story.
Yeah.
Okay, so question, it's sort of relevant to what we've been talking about. EW Lee 03, I think it was Eric Lee. Question for next time. Do you see managing permanent capital as conveying a significant competitive advantage in investing? Buffett effectively has this, and Bill Ackman is also big on the concept. Einhorn too. That's me adding that. If so, what are the implications for the fact that most managers don't have permanent capital and yet in the case of equities are investing in long duration assets? Good question.
Very good question.
I think we've kind of covered that earlier with the high performance conglomerate question, but yeah, that's the problem for anybody managing money is that when the opportunities arise, all of the firepower gets taken away, and so they can't deploy, which is why some guys try to carry cash and trim back. That's certainly the holy grail. It makes you behaviorally a much better investor to know that the assets are going to be there when the market pulls back. Gents,
I would actually be even more forceful about this and say that I am not convinced that value as a strategy is appropriate for most people. I think they just maybe don't have the capacity to suffer, and it will require that. And it's not just about like, oh yeah, like buying things with scary headlines. It's worse than that. It's periods like today that just grate on you day after day, and you're watching things go up that don't make sense to you, and you're not finding enough ideas. That part of value, I think, takes a very special sickness maybe to participate in that. And unfortunately, if you're more of a casual value person, you're likely to get knocked off the bandwagon right when it's probably going to start working again. And you're not really doing anyone any favors by being a value person when it's easy. So I guess buyer beware when it comes to value as a strategy. Simple,
Casuals.
not easy. Casuals. I know. It's kind of a dismissive term, huh?
The value tourists.
Yeah.
I mean, the thing about the permanent capital is I don't know that you read the headlines about how great Ackman's year was this year if he doesn't have permanent capital.
Yeah.
Because there were some
game over.
terrible years 2 or 3 years ago, and people could have pulled their money. I think I might be wrong, but I think even he had commented that it was nice to have the permanent equity vehicle. But yeah, I mean, I think that you've got. We talked about is it a replicable model? I mean, yeah, it is, but it's hard to get there. And then if you can get it, it's a hell of an advantage, I think.
Just on the Ackman thing, the bloke I used to work for, who's private, so I won't give his name, but he likes investing in closed-end funds. He likes investing in things that are trading at a big discount to their net asset value. When he saw that Ackman vehicle had traded down to a big discount, he was still a believer in Ackman. Flew to New York, met with the team, put 20% of his net worth into that thing, and I think he's up like 100%, something like that, in pretty short order, in like 18 months or something like that. So
good for him. A lot of people didn't believe in Ackman, and the best criticism that I heard of him, and I think maybe the most legitimate.
Too handsome.
Yeah, well,
he's a good-looking bloke.
Somebody said to me, I think he might not be a great capital allocator. But in that same sentence, they also said he's by far the best analyst I've ever met. Yeah. Like, it's not even close. So their only quibble is with bet sizes and what positions he took.
I still think that's 50% of it. I still think that's half of it. Maybe
it's a
more.
Big deal.
Maybe you put a guy who knows how to bet at the top with a guy who's a better analyst underneath him, and you get better results.
I'm not going to take a shot at Ackman here, man. I dream of having his rep.
So let's move on to the next one. What are your thoughts on a 2%, almost roughly 2%, of personal account hedge by doing a leveraged inverse ETF SPXU given today's market valuations? That's Alan Sisner. Thanks, Alan. Great question. Jake?
No, thank you.
Why not?
My understanding of those type of vehicles is that the decay in them is pretty rough, and so you have to be. They're much more trading vehicles and should be handled like plutonium and only like short exposure. Short amounts of time that you should have exposure to them. You don't want that to be sleeping under your pillow with you. So I think those are inappropriate for a hedge of any kind of longer duration. And if anything, this market has taught us is that it's going to take longer than you ever thought. So to be able to get the timing right and avoid that decay, I just don't really like your chances of that. So I prefer to make everything simpler and view cash as a call option on lots of great things to buy that requires no timing. Especially if you're permanent capital and don't have to report against a benchmark. I think that's probably the smart play for myself. I think it's more conservative and gives you a better chance of getting to the finish line.
Bill?
Yeah, I guess I have a couple thoughts. One, what are you really like? What's your forecasted drawdown? Because to me, 2% doesn't really seem like a real hedge. And then two, to Jake's point, I subscribe more to like the Greenblatt theory where he said, pick your ideal allocation, and then if you're more bullish, you can reduce. So say your ideal allocation's 75-25, bonds, equities, or whatever. If you're super bullish, you could go to 85-15, and if you're really bearish, you could go to 65-35, and give yourself sort of a 10% range that you can sort of make like a market call with. But it ensures that you're generally around an allocation. And I would rather play a hedging game that way than I would try to get short, because timing matters so much. And I don't know. I just think you're sort of overcomplicating the whole thing.
Yeah, that was my thought. Basically, 2% is not enough protection, and you're probably just going to get that attrited away. I think that's a word, attrition, attrite. I have to look that
Australian. It's Australian for losing money.
I have done lots of dumb hedging, and that all started in about 2010. So I'm definitely behind on all of it, and it would need like the market would have to go like negative 10 or something for me to make that money back. So yeah, I'm no longer a believer. The timing's just too hard. You lose too much money on it. I think that Bill's got a much more sensible approach where, sometimes you're gonna lose a little bit, but you're better off, I think, in the long run, compounding over the long run to keep your exposure up. All right,
those are nice guardrails. I like that.
Yeah, those are good ones.
What's up?
Those
are good guardrails.
Yeah, Greenblatt's a smart guy.
He's no dummy.
No.
This one's from Patrick Rossi. I think Patrick's in Italy, so there's one of our listeners in Italy, which is awesome. Do you believe that, as Buffett says, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it's the reputation of the business that remains intact? Do you guys still think that's still valid?
Every time that I have thought management can overcome the reputation of the business, I've lost money. So yes, I still believe that that's probably right.
I'm going to take the opposite view, actually.
Fade and Buffett, how dare you?
I know it's sacrilege. I think maybe with the increase in the advancement of technological change, the businesses are just maybe not as moaty as they were at one point. And now it probably maybe requires a little bit more of a good manager to find the next thing that's smart to work on potentially, or even know when it's time to stop working on it and maybe like start liquidating. I mean, I think that's still a pretty underappreciated and heroic thing that a capital allocator can do, is to recognize that the business doesn't need to be built into an empire if it's in a declining, secular decline, and just managing it properly and returning capital to shareholders in a disciplined way. I salute those kind of people, even though they kind of get a bad rap as like vultures or something. But I mean, vultures fill a very important niche in the ecosystem of biology, and there's no reason that we don't need that also in the complex adaptive system that is our economy. So I think maybe having that smart person might be a better advantage today. Well, let me try to like invert it. Like if you gave I don't know, like the Shopify CEO, who's very hot right now, everyone loves him, right? You gave him a pile of money and said, like, go start a business. Would you want to bet against that, or would you rather maybe Shopify's already a really good business and you replaced him with someone that's like a bonehead? Which of those two would you want to bet on for having longer return outcome?
To your question, Jake, I was smiling halfway through because you were reminding me a lot of Munger, and then you went on to go in with the inversion take. So you're officially Munger today.
Yes.
I guess that. So as far as Toby's concerned, I think that he's a guy that could potentially end up like Bezos. It appears as though the stock is priced that way, right? But I mean, that could be one of those unique situations. I still think if he gave me the choice between a bozo running a software company, let's not make it Shopify for a second, but like an ERP or like a enterprise software company, something like that, I'd rather take a bozo running that company than a really smart genius in a commodity company. So I still think that the base rates of the businesses matter. But I do agree that management also matters. If that makes sense.
Does it matter more today than it used to? Management?
I don't know, but one thing that you had said a while ago that I thought was smart, you had mentioned that like a good capital allocator makes a business anti-fragile a little bit or helps with that, and I think that that's really true. So I don't really know that I'm answering the question, but it certainly anything that relied on a distribution moat or inertia or whatever. I mean, those moats are eroded more than anything. So yeah, I guess it matters more, probably.
I think the sort of proof of that is the cigarette companies. I think it's hard for cigarette companies to get kind of the best of the best because nobody really wants to be seen to be selling cigarettes, and even Buffett's talked about being uncomfortable investing in them. But those are just unstoppable businesses that even though sort of nobody really wants to invest in them, nobody wants to be associated with them. The underlying and fewer people are smoking, but the underlying growth in the revs and the profits, and they're just unstoppable.
Well, there's literally one investor that I've ever heard that says well, hopefully more people smoke, right? And it's Lawrence. What is it, Lawrence Hamill, right? Yeah. I'm like, oh, okay, yeah, maybe that's an interesting thing to root for. So this is
that might be libelous. I don't know if he said that or not.
I'm almost certain he said it on your podcast. I'll listen and send you the minute. I'm
just protecting myself, Bill. Just hanging you out to dry.
Toby's a lawyer by training, right?
Recovering. So's Bill.
I don't know what I was gonna say. I lost it.
I think we're coming up on time, so let's.
We've derailed.
Before Lawrence comes to sue us for the $1.98 we make every week, gross. We'll see you guys next week. Thanks for listening. It's always a lot of fun to record these, gents.
See you, boys.
Have a good one.
Move with the rhythm. Shake it up, stop when the clock hits 13. Sing one.